Good afternoon to my East Coast listeners and good morning to my West Coast listeners. I'd like to preface this webinar by saying that I, for some reason, have been having technical difficulties with this webinar. I got kicked off twice. So what I've decided to do, what I have decided to do is to continue recording the webinar and just send out the replay to everybody who signed up. So because of that, you're not going to see any interactions as it relates to people asking me questions and me answering those questions, but feel free to email me any of your questions. Okay, so let's get this party started. Okay, so the name of the webinar, of course, is called How to Protect Yourself from IRS Collections and Resolve Your Back Taxes, presented by myself, Desarie. Okay, so who am I? My name is Desarie Anderson, and I am a certified public accountant licensed in the state of Georgia. I'm also an enrolled agent, and for those of you that don't know what an enrolled agent is, we are individuals licensed by the Internal Revenue Service or by the IRS to represent taxpayers. So that's what we do. It's not a very popular designation in terms of people knowing about it, but it's a very important one because enrolled agents specialize on taxation. So usually if you're looking for someone who specializes on strictly taxation, you would seek out an enrolled agent. Now that's not to say that that certified public accountants don't specialize in that area, but with public accountants, we have the option to go either way. We can specialize in taxation or not. We don't have to. We can stay on the accounting side. But an enrolled agent specializes in the area of taxation, so they're a very good resource. I'm also a year-round tax advisor and an accountant, and I like to claim to be a public speaker. Because years ago, I would rather be dead than speak in public. So now I'm trying to reverse that. And rather than being the person in the coffin, I'd rather be the person giving the eulogy. So that's changing. And I'm also an educator. I love to educate. I think education is very important. Okay, so who is this webinar for? So this webinar is for anybody who owes money to the IRS or anybody who actually has, or a practitioner who has clients who may not do representation work, but you do have clients that happen to owe money to the IRS, and you may be trying to find a solution for that particular client so you can give them further advice. Okay, so in my practice, from my experience, the largest population of individuals that I happen to work with are independent contractors and self-employed individuals. Now, basically, anybody that's responsible for paying their own quarterly taxes, those are the types of clients that tend to walk through my doors that have IRS problems. And the reason is because usually these individuals make money all year round, and because they're responsible for paying their own taxes, they tend to neglect paying their quarterly taxes, which at the end of the year, when they finally do their taxes, they wind up owing a lot of money, and they can't really afford to pay the entire amount up front. So they'll just file the return without sending in a payment, and then the cycle begins. They do that year after year after year after year, and they find themselves in a position years down the road where they have 5 or 6 years of payments that they have not made. And now the IRS has come knocking. And then you have the other segment of people who file their taxes and then they see how much they owe and then they get scared. They get scared that if they continue filing, that they're going to open up a can of worms and the IRS is going to come after them because now they've told on themselves. So they just stop filing altogether. And that's not necessarily true, because if you don't file, the IRS will be looking for you. Because most times these independent contractors may have 1099s that go to the IRS, or they may have 1099 miscellaneous, or 1099Ks, that's if you accept credit cards, that go to the IRS. And so the IRS knows you're making money, so eventually they're going to come for you. Okay, so I always tell my clients, don't be afraid to file a tax return. It's better that you owe the IRS than not filing at all, because technically speaking, it's against the law to not file a return, but it's not against the law to owe the IRS money. Okay, so who can help you and what must they know? So one thing that you need to know as consumers is that there are only three types of people that can help you if you owe the IRS: certified public accountants, enrolled agents, and attorneys. These are the three entities that are allowed to represent taxpayers before the IRS. So you need to make sure when you're trying to seek out someone to help you with your tax problem that you're contacting either one of these three individuals. Another thing that these individuals need to know, they need to understand the IRS collection process, because it is a process, and is a process from beginning to the middle to the end, and they need to understand what the process is. They also need to understand the IRS financial guides, because these guides are what the IRS uses to determine if you qualify for an installment agreement, what type you qualify for, and also if you qualify for OIC, which is an offer in compromise. And also they need to know the collection alternatives. There are different types of alternatives that each individual can fit into. So I always say, if I have 100 people that I happen to be representing before the IRS, out of the 100, there is an alternative that each one is going to fit in. So it's going to be different for everyone depending upon what your personal situation is. So the topic of discussion, without having to read all of this, but I'm going to read it anyway, is going to be statute of limitation and how that affects your tax debt, IRS liens and levies, why are you liened, why were you levied, and how to remove the lien, how to get rid of the levy, the different types of installment agreements, the offer in compromise, also known as pennies on the dollar. And I do know that for most of you, when you're driving in your car or you're up at night listening to television and an advertisement comes on, you hear, oh, we'll settle your debt for pennies on the dollar. But what they're really saying is they're really referring to the offer in compromise. So we'll talk a little bit about that and talk about who really does qualify for that particular option. And then we'll talk about discharging your debt through bankruptcy, which technically speaking is more for an attorney, but I'll just touch on that. And then I'll talk about years of unfiled tax returns. If you haven't filed tax returns in a while, what you need to know about that and what your rights are. Okay, so how the collection process starts. Usually the collection process starts after you file your tax return and the IRS assesses a tax. Now, usually if you once you're done preparing the return, you see how much you owe. If you send the return in with how much you owe, case closed. The IRS is not going to contact you. They just say bye-bye and we'll see you next April 15th. On the other hand, if you do not send in what you owe with a tax return, this of course starts the entire process of collections. This, and also if you don't file a tax return and then the IRS goes and files it on your behalf based on the information that they have from you that they collected from a third party, they just go ahead and file the return for you, say that you owe $1 million, and then the collection process starts. Okay, so how does the collection process start? It starts with love letters. The first love letter they send you is telling you, excuse me, Miss Anderson, you have a balance with us. Okay, let's assume I ignore them and say, I'll speak with you later, I'm not interested right now. Then they'll send me another letter and say, hello, did you forget about us? We're still here. You still have a balance. When we haven't heard from you, when are you going to contact us? Okay, so if I further ignore them, then they start threatening. They'll say, okay, I'm tired of you ignoring me. Now it's time for us to threaten you, basically. Then they send you a letter of intent to levy. And they say, okay, we've tried to get a hold of you. You have not responded. So now if you don't respond, we are going to levy your assets. These assets can be bank accounts. It could be your paycheck or whatever the case may be. Okay, so let's assume you say, okay, IRS, please leave me alone. Stop sending me these love letters. I'm not interested in you. Then they'll say, oh, okay, really? We're going to send you another letter. And this particular letter, we are telling you that we are going to now levy your assets. However, we are giving you 30 days to respond, in which case you can file a collection due process, or rather it's a collection due process where you can go ahead and contact the IRS and appeal. Okay, now you have 30 days to do that. If you don't do that within the 30 days, then at any point moving forward, the IRS can surprise you and levy your assets. Now, let me just say this. It could happen 30 days after the fact. It could happen 60 days after the fact. It can happen 6 months after the fact. You don't really know when they're coming. In my experience, I've seen it happen sooner than later. Sometimes you wonder, did the IRS forget about me? I know they threatened to levy me, but I haven't heard anything from them. And then all of a sudden, out of nowhere, you get levied. Either your employer lets you know, oh, hello, the IRS is trying to levy your paycheck, or you go to the bank one day and try to withdraw money and your account is frozen, or your bank contacts you to let you know that there's a levy, or whatever the case may be. However they decide to do it, you may not see it coming because it may have been a while since you received this letter 1058 or the letter or the L11 notice. Okay, so what is the statute of limitation? Basically, the IRS has 10 years from the date of assessment to collect a tax debt. Now, if for some reason they don't collect it within that 10-year time period, for whatever the reason may be, then that debt becomes completely uncollectible. So let's look at an example. Let's assume you have a 2005 tax return that you filed on April 15th, 2006, okay? But then the IRS, they assessed the tax on April 20th, 2006. Now, I don't know if I said 2016 or if I said 6, but you can see what I'm trying to say. A 2005 tax return filed 4/15/06, and then the tax was assessed on 4/20/06. The IRS now has until April 19th of 2016 to collect that debt. If they don't collect the debt by then they can no longer collect the debt. The debt becomes completely unenforceable. And there are different reasons why you may happen to be one of the lucky ones who was able to ride it through the statute of limitation. But also keep in mind that even though there is a 10-year statute, there are certain circumstances that can toll that debt. Now, when I say toll the debt, what it means is, even though it's 10 years, if you file bankruptcy, if you have a pending installment agreement, these things can toll the debt. So that means that, yes, you had 10 years, but while you were filing for bankruptcy, let's say while you had a pending installment agreement, let's assume that it took the IRS, let's just assume 6 months to get through the pending installment agreement. That means that your statute of limitation is now 10 years plus 6 months plus an additional, sometimes it's an additional 30 days that they tack on. So the statute, although 10 years, it can wind up being 12 or 13 years. And a good example is if you file for an offer and compromise. If you file for an offer and compromise, and the offer and compromise, let's assume it takes about 18 months for the IRS to finally agree or not agree or do whatever the case may be. If they decide not to agree, that means that entire time period while you were applying for the offer and compromise gets added on to the statute of limitation, plus an additional, I want to say, it could be 6 months. I'm not sure right now, but you can research that. So just for your information, so yes, it is 10 years, but there are other things that can cause it to be longer than 10 years. Okay, so how the IRS gets your attention. The IRS gets your attention through either a tax lien or a tax levy. A tax lien, as most of you know, is a public notice, and a levy is seizure of your assets. So the tax lien basically is the IRS goes and they record a lien in the county that you live in. The levy seizure is that they seize your personal assets. Now, one thing I have to say is, with the IRS, If you have a tax debt and you owe the IRS, automatically that you have a lien against you. It's automatic. Okay, the IRS they don't have to go to court to try to get the judge to agree to lien you. It's absolutely automatic the minute you owe the IRS money. Now, whether or not they file the lien is a totally different story. If they file the lien, that means they're putting the public on notice that, oh, by the way, I'm just letting you know that we have a lien against this person, and that so if they sell anything, if you give them any loans or whatever the case may be, it can be affected by the lien. Now, if the IRS does not file the lien, or rather, if they do not file the public notice, that means that there is no record showing that you have a lien against you, so nobody's going to know. That being said, remember, automatically, the IRS, you do have a lien against you. It's just a matter of whether or not it has been filed. So I wanted to make that clear. Okay, so what is a tax lien? As I said earlier, a tax lien is a public notice. It attaches to every single thing that you own or will own in the future, including cash. Sometimes people say, let them lien me. I don't care. I own nothing. Okay, true. You may own nothing today, but in about 5 to 6 years, you may own something. So that lien follows you wherever you go for the stuff you have now into the stuff you're going to have in the future. Okay, so usually with IRS lien, it supersedes all other liens with the exception of a mortgage and property taxes. Those are the only two liens that the IRS lien does not usually supersede. Okay, so a lien attaches to you, as I said earlier, automatically by law. A notice may be filed if you owe over $10,000. So normally, if you owe over $10,000, this is when the IRS starts to say, okay, we may go ahead and just file the notice. Now, I've seen the IRS file a notice for less than $10,000. I have. And I've seen people who have debt for way more than that, who have not had a notice filed against them. So there is no science to how the IRS does things. They have their rules and their regulations and things that they can do. Now, whether or not they do it to you is another story. So you can have the exact same situation with another person. However, the way the IRS treats both of you may be different. And usually it's because they're short-staffed. So they just don't have the manpower to just do everything that the law states that they are allowed to do. Okay, so when you have a lien, you cannot transfer or sell assets that are covered by that lien. If you owe under $25,000, the IRS will remove the lien if you agree to certain terms. So what this means is, let's assume that you owe the IRS, I'll say $30,000, and then they decide to file a notice of lien against you. And you're trying to buy a house, you're trying to do something that affects, that lien happens to affect. So you want to know, okay, how can I get this lien reduced or taken off? The IRS will remove the lien if you bring your debt down from $30,000 to under $25,000. They will then agree to remove the lien under the condition that you agree to have your either your paycheck automatically debited, not debited, but automatically, you know what I'm trying to say, or have your bank account automatically debited. Then they will go ahead and remove the lien, and you can go ahead and do what you need to do. Okay, there are 3 ways to remove a tax lien. Either by applying for a discharge of an asset, apply for a subordination of rights, or apply for a complete withdrawal. So when can you apply for a discharge of an asset? Let's say, for example, you have a lien against you and you own a home, you own a boat, you own a vehicle, and you decide that you want to sell that boat. Now, in order for you to sell the boat, remember the IRS has a lien on that. So you can't just go around selling stuff without them, discharging or doing something. So the IRS will agree to discharge the lien on that particular asset if by discharging that lien, somehow it benefits the IRS. That means they're going to get money from you. It means that you are going to pay something down, which means now you can start afford to pay them more money. So they'll agree to this. They'll agree to discharge that lien, but it has to be to their advantage. And they will discharge the lien only on that one particular asset. So let's assume you have 6 assets that are covered by the lien, but you want to sell one asset. They will discharge the lien for that one asset, but the other 5 are still going to be covered by the lien. Then you have the subordination. What the subordination is, the IRS says, okay, we have rights above a particular person. However, we are going to subordinate our lien on you. We're going to sit back and take a back seat, so that way you can go ahead and do whatever it is that you need to do with that particular asset. And usually with the subordination, we're talking about, let's say you wanted to refinance. You wanted to refinance your house or refinance something, but the person or the lender is concerned about the IRS's lien being ahead of its particular lien. Well, the IRS will subordinate if the refinancing is going to somehow benefit the IRS. So you might refinance in order to take money out to pay the IRS. You might refinance to pay down a debt, which means now you have more money to pay the IRS. They'll subordinate the lien. So basically the question is, what's in it for me? If I subordinate this lien, what is in it? What is in it for me? There has to be an advantage to the IRS in order for them to subordinate a lien or to do anything with that lien for you. And finally, applying for a withdrawal. Basically, as I mentioned earlier, the IRS will agree to withdraw a lien if you owe less than $25,000 or if you have satisfied the debt that you have with them. What's a levy? The levy is the taking of property by the IRS. They will take your stuff. Okay. Now the property is used to resolve any back tax debt that you may have. So what are the most common types of levies out there? Well, paycheck, which means that they're going to garnish your wages. Now, when they garnish your wages, they're going to contact your employer and they're going to say, okay, here's what we need for you to do. And as I always say, they put all your business out there on Front Street with your employer, letting your employer know that, oh, you don't pay your taxes. Who wants that, right? It could be embarrassing, but they don't care. They just want their money. So garnishing of the paycheck, also your bank accounts, any account with your name on it, any account. So let's assume that your mother says, oh, Desarie, can you please put your name on my account for whatever reason? Let's assume your mother is elderly and she puts your name on her account. Well, even though it's her money, your name is on the account. So the IRS can levy, and not even can, if they find it, they will levy that account because your name is on it. And I've seen it happen with a client of mine who his name was on his elderly mother's account, and they levied the entire $50,000 that was in the account. And he kept on saying, well, it's not her money, or rather it's not my money, it's my mother's money. They don't care. They don't care. As long as your name is attached to something, they're going to come for it and come for you. Now, another one, of course, is accounts receivable. If you own a business and you have accounts receivable with your clients, they can levy that as well. Now, I recently had an experience with a client of mine who is a hairstylist, and she uses Square to collect money from her clients. Well, the IRS, she received a letter saying that, oh, by the way, the IRS is levying or has levied your Square payments, which means that for a time period, all of the payments that she received from her clients got levied by the IRS. Now, she said she didn't see it coming. She said she received no letters. However, usually the IRS, they normally do send you letters. They send you letters to let you know that, yeah, we're coming for you. We're coming to levy you. And normally people may not realize that they received a letter for a couple of reasons. One, because the letter comes in and they just ignore it and say, oh, I'll open it later. And they may forget to open it. And as each letter comes in, they don't open it. They just shove it under the kitchen sink or throw it away. Or I was on a TV show one time, and the guest said, oh, well, one of the things that they shouldn't do is send a letter back to the IRS, which I thought was very funny. But yeah, of course, don't send it back to the IRS. So you either put it in the trash or you just ignore it, not realizing that as you are ignoring those letters, some of those letters may be telling you that they're about to levy your account. So you may or may not see it coming. But yes, they will levy your credit card processed payments. And that's the worst thing, because you definitely don't see that one coming. And for those of you that have franchise businesses, let's say you're a realtor or you own a business and your franchisor happens to be paying you, they can come after you that way. They can go to your franchisor and say, okay, we want you to levy this person's income before you send it to them. Okay, so why were you levied? Basically, the IRS resorts to levying when all other communication with the taxpayer has failed. So they've tried to contact you time and time and time again, and you've decided, oh, please just stop it. You're like a gnat. You just want them to just go away. But as I said earlier, they don't go away. Or the taxpayer has defaulted on a payment plan. So if you already have a payment plan with the IRS and you default on that payment plan, which means that you've been paying for a while and then all of a sudden you just stop paying. Well, when you stop paying, they're going to start sending you letters saying, oh, hello, you owe us money. Of course, if you ignore that, they'll tell you, okay, either you pay us what you owe us or we're going to levy you. So those are the two reasons why people two reasons why people get levied, basically. Okay, so there are two types of levies. There's a regular levy, and then there is a continuing levy. A regular levy only seizes what is available at the time the notice is received. So that means that if you have $5,000 in your account when the IRS levies you, or when the bank actually receives the notice to levy, that's all the IRS is going to take. It's a one-time levy. They take the $5,000 and that's it. That means that if you deposit, so let's assume, let me try to explain this a little better. Let's say that the bank receives the letter on October 21st. And on October 21st, you have $5,000 in your account. The IRS is going to levy the entire $5,000. Let's assume that on October 22nd, you deposit another $5,000. Well, that is not going to be levied by the IRS, because all they're going to levy is what was in the account the day that the bank received the notice of levy. Okay, normally the bank is going to hold the funds for about 21 days. Now, within those 21 days, if there is some kind of way that you can go ahead and sort out your situation with the IRS and set up an agreement with them, all within 20 days, then they will release the levy. Also, let's assume that you can't get all this done but in 21 days. That means the levy is going to go through. Furthermore, let's assume that you are completely compliant and all you have to do is set up an installment agreement with the IRS, which means that, okay, there's less that you have to do. You don't have to go back and file all those tax returns, which means there's a lot of time that's going to be saved there. All you have to do at this point is to set up an agreement with the IRS. Okay, so let's say you set something up and you wind up not being able to pay them back based upon how much money you're making and how much your expenses are, of course, based upon the IRS's financial guides, then they will go ahead and release the levy anyway, because the levy is putting a hardship on you. With that levy, you're not able to pay your rent. You're not able to pay your bank account. Pay your electric bills and all of that. But of course, they're going to want to see proof that you can't do these things. If you are able to prove that you can't do these things within the 21 days, they'll go ahead and release the levy, and then you can start going through the process of trying to get some type of agreement in place. I've had several of those where the IRS has agreed to release the levy, and sometimes they will release part of it. They may not release the entire amount. They may do a partial levy release. Then there's another one called the continuing levy. Now this one is, once the notice is received, the levy stays in place until it is released by the IRS. This means that, remember on October 21st, you deposited $5,000. The IRS grabbed that. On October 22nd, you deposited another $5,000. Well, remember, with the regular levy, the IRS can't touch that, won't touch that. But with a continuing levy, they're going to take that $5,000, and they're going to keep taking money as it comes into your account until you set up an agreement. So that's a continuing levy, which means it's continuous. It doesn't stop. Now, normally, when the IRS levies you and does a continuing levy, they basically seize your entire paycheck. They'll seize your entire paycheck minus the standard deduction and personal exemption for that particular year, each pay period. Now, I'm not going to do the numbers, but just to let you know that, let's assume that you get $400 every month. Or rather let's just say $1,000 every week. Well, the IRS is going to take every dime of that minus your personal exemption and your standard deduction. And so let's assume that as of 2018, the personal exemption no longer exists. We're only dealing with the standard deduction, which is $12,000 as of 2018, which means that the IRS, you can take $12,000, you can divide that by, 52 months, see whatever that is. They'll leave you that on a week. No, I'm sorry. You can divide, let's say you get paid on a weekly basis. You can divide the $12,000 by, the 52 weeks and see what number that is. Okay. And let's say you get paid on a weekly basis. You get paid $1,000 a week. Well, what the IRS will do is they will take out whatever that is, the 12,000 minus 52 12,000 divided by 52 weeks, whatever that dollar amount is. They'll take that out, leave it for you, and take the rest of your money. No one can pay their bills on that. No one. So what they're doing there is they're trying to show urgency, saying, okay, you need to hurry up and contact us so we can go ahead and settle this matter. So continuing levies are pretty ugly. I've had a few of those and they're really ugly. Okay, so how to avoid an IRS levy. Number one, do not ignore IRS notices. As I said before, don't throw them away. Don't send them back. Do not put them under the kitchen counter. You want to make sure that you address the issue, either by calling the number on the letter or by contacting your CPA, your attorney, or your enrolled agent. Okay, so once the IRS requests documents, you want to provide the documents requested. Okay, just provide them with what they want. And third, do not default on a payment plan. If you have a payment plan with IRS, don't default on it, because if you do default, then they will threaten you once again to levy you. Now, let's say that you're paying $500 a month for your IRS tax debt. And for some reason, something happened in your life that you can no longer afford to pay $500. And it's legitimate. Whatever happened is a legitimate reason why you can no longer afford it. And your finances show that you can no longer afford it. Well, rather than just not paying the IRS anymore, you can actually get that agreement recalculated. So all you have to do is resubmit your financials to the IRS. They'll look at the numbers. And if after they review it, you can now only afford to pay $150 a month. They're going to say, fine, not a problem. We'll take the $150. You no longer have to pay us $500. So don't ignore it. Just, face the problem. Say, okay, I can't afford it, and try to get your agreements recalculated. Okay, so can I request a levy release? I think I discussed that earlier. Yes, you can. You must provide full financial information to request a levy release. You must demonstrate that the levy creates a financial hardship. This is something I mentioned earlier. If it is proven that it presents a financial hardship, the IRS will release either the entire levy or partial. Okay, so now let's talk about tax debt resolution alternatives. So as I mentioned during the beginning of the webinar, there is a solution for everyone. Okay, so we have something called currently not collectible, we have installment agreements, and we have the oh so famous offer in compromise that everybody seems to want to be eligible for. Okay, so what is currently not collectible? Currently not collectible means that you have very little to no assets. It means your income is just enough to cover your expenses. Now, I would like to say this, that, okay, when I say that your income should be enough to cover your expenses, not the expenses that you say you have. The IRS don't really care about your expenses or how much they are. There is a guide, okay? It is based upon the IRS's standard. The IRS has a standard. So depending upon the state you live in, the county you live in, there is a set standard that the IRS gives to everyone. They'll say, okay, you live in DeKalb County, therefore we're telling you that we are giving you, I'm just throwing out some numbers, $1,500 a month for expenses. That's all you are allowed. If you have more than that, then let's talk. Let's see if somehow or another it's okay with us. But for the most part, they go by their standards, give or take. So you can't just say, oh gosh, my expenses come to $8,000 a month. I can't afford to pay the IRS. That doesn't work. They don't care about the $8,000. All they care about, they'll say, you go figure out a way to reduce it. That's how they see things. Okay, so if you do qualify for a currently not collectible, basically what the IRS is saying is, okay, you owe us money. You know you owe us money. We know you owe us money. However, it's clear to us that you can't afford to pay us what you owe us at this time. So what we're going to do is we are going to go ahead and take you off of collections for now and see what happens in the future. Now, when they take you off of collections, the penalties and the interest continues to accrue. It continues to accrue, which means that your debt is increasing. So if your debt happened to be $50,000, by the time it's all said and done, it might be $85,000, where 35 could be penalties and interest. It doesn't stop accruing. It continues to accrue. Also, in order for you to be eligible for currently not collectible, you must complete a financial statement. Now, the financial statement pretty much tells the IRS how much money you're making and what your expenses are. And like I said earlier, the financial statement is only giving you certain allowable expenses allowed by the IRS. And that's what they want to see. They want to see exactly what it is that you say you're paying and whether or not it falls under the umbrella of, okay, yeah, you can get away with that one, or you can't get away with that. Now, if you are put on currently not collectible, a tax lien will be filed against you automatically. So which means IRS will go to the public, go to your county and file the lien with the county. That's automatic when you are on currently not collectible. Now, generally speaking, the currently not collectible status normally lasts from year to year, meaning that they review your situation on a yearly basis. So let's say, for example, you're currently not collectible in 2018. Usually in 2019 or 2020, they're going to go back to see whether or not your financial situation has changed. Now, one thing that they do tell you, they say, okay, you are on currently not collectible, which is also called CNC. When your situation changes, we want you to give us a call and let us know that your situation has changed so that we can start to, take money from you. Now, let's be real. How many of us are going to call the IRS and say, hello, IRS. Okay, my situation has changed. I'm now making more money. I will now like to start paying you what I owe you. Now, most people aren't going to do that. Really, they're just not. And the IRS, they know that, but they still say, yeah, we want you to contact us. So because they know that people really aren't going to contact them, then what they do is they just do their own review. They'll do their own review and they'll see, okay, your situation has changed based upon records that we are receiving from outside individuals. So in other words, they may be receiving W-2s from your employer showing that you're now making more money. They may have received 1099s. They may have received some type of income showing that you're now making more money and now you can afford to pay them. So if they review your financial situation and they determine that you can now afford to pay them, then they're going to kick you off of CNC and start sending you those love letters all over again. I have a client who has that type of situation where she pulls money from a retirement account, and because of doing that, it kicked her out of currently not collectible status with the IRS, even though her true status hasn't changed, but it did kick her out of currently not collectible status, and now she is required by the IRS to start paying them all over again. So I'm working with her right now to try to change that and try to put her back into currently not collectible status. Now, let's assume that your financial situation does not change for the entire time that you have a tax debt, and it just so happens that each tax debt that you have reaches the statute of limitation. This means that the IRS will never collect the money from you, because if the statute expires, that means that they can't collect it. So if somehow, one way or another, you're able to remain in CNC for 10 years based upon the date of assessment for each tax return, that means that you will never have to pay the IRS again. Okay, so installment agreements. What is an installment agreement? Also known as an IA. So an IA is an agreement between you and the IRS that allows you to pay what you owe in monthly installments. Okay, so what if I can't afford to pay the IRS all at one time? Then, if that's the case, you qualify for some sort of installment agreement. So we have different variations of installment agreements. So there are basically 4 variations of them. One is called a guaranteed, one is called streamlined, and I'm going to talk about the streamlined because there have been some changes with that recently. Then there's a regular IA, and then there's a partial IA. So what's a guaranteed? So a guaranteed basically is that means that the IRS, no matter what, they're going to accept your whatever you propose to pay them. It's guaranteed. They're going to accept it. No questions asked. They don't want to look at any financials. They'll just say, sign on the dotted line and let's do this. Now, what are the stipulations for a guaranteed agreement? Okay, you have to owe the IRS less than $10,000. Number one. You haven't owed tax or had an IA in the past 5 years, meaning you mustn't have owed the IRS within the last 5 years. You must be able to pay the full amount within 3 years. So if you owe $10,000, let's divide 10,000 by 12. I don't have a calculator on me, but I'm sorry, not by 12, by 36, because 3 years is 36 months. I think it's like $278 if I'm not mistaken, which means that you would have to pay the IRS about $278 in order to pay them off within that 3-year time frame. So they don't care how much you propose to pay them. As long as it's going to pay off what you owe within that 3-year time frame, then they're going to approve the guaranteed agreement. And also, as I mentioned earlier, no financial statements are required. Then you have your streamlined agreement, which has changed, through the years. It has, fluctuated. So I know some of you have heard something called the Fresh Start program. And I know people assume when the IRS says Fresh Start program, they're saying, okay, we're going to throw away everything you owe and start from fresh. Meaning that, okay, you owed us $100,000. Okay, we forgive you. We're going to start from fresh. Now, let's move forward from that. Well, that's not really what that means. Basically, the Fresh Start program was just a way to ease the pain when it comes to paying the IRS back. So before the Fresh Start program, the rules were a lot more stringent, and what you had to pay back was a lot more on a monthly basis. With the Fresh Start program, they have expanded things where you no longer have to pay quite as much as you would have been required to pay prior to the Fresh Start program. Okay, so who qualifies for the Fresh Start program? If you owe less than $50,000, you qualify for the Fresh Start program. Now, you see it says 100,000 beside that because I think it was in 2017, if I'm not mistaken. It may have been September or sometime in 2017. There was a pilot program that was started by the IRS where they tried to expand this Fresh Start program from $50,000 to $100,000, meaning they were going to place the exact same rules for the streamlined agreement for people that owe less than 50, from now people that owe 100 or less. Now, this particular program was extended through September of 2018, which is last month. Oh no, wait a minute, we're in November now, which was a couple months ago. So it expired 2018 September 30th. However, I have heard that they're going to make it permanent. Now, I'm not 100%, well, I'm almost 95% sure that that's the case, that they are now making it permanent. So now everything that I'm saying about streamlined not only applies to $50,000 and less, it pretty much applies to $100,000 and or less, with a couple of variations. Okay, so for a streamlined, you have to be able to pay the IRS back in 72 months. However, that changes to 84 months if you owe between 50 and 100,000. So by them expanding the amount of time that you have to pay them back, it reduces what you have to pay on a monthly basis. Now, the disadvantage to this is, of course, interest and penalties keep accruing, which means you wind up paying them more, but at least it's less painful on a monthly basis. Now, the advantage of this streamlined agreement is not only the fact that the IRS has said, okay, we are going to go ahead and expand the amount of time that we're going to allow you to make the payments, but we're also, because prior to the Fresh Start, it was, you had to pay back in 60 months. So you had to pay back what you owed in 60 months, which is 5 years. Then they changed that to 6 years, 72 months. Now they've changed it to 84 months if you owe between 50 and 100. But now the main advantage to this streamlined agreement is the fact that you no longer have to show financial statements. And you'll see what I'm talking about. You'll see the advantage of that when I move on to just a regular IA. You'll see what the difference is. Okay, so for a regular IA, you have to owe, I'm assuming now it's over 100,000, since the 50 to 100 now falls within the streamline. Now one other thing also, I do believe that if you owe between 50 and 100, even though you're not really required to show financials, I do believe that between 50 and 100, you have to agree to a direct debit from your bank account, or to have a payroll deduction. If you agree to that, then the IRS won't look at financials. And even if they do look at financials, they're going to look at it, I wouldn't say casually, but they're not going to dissect it as hard as they would if you were going through a regular installment agreement. So that's one of the differences. Now, with a regular agreement, financial statements are required. Okay, you must pay the amount in full within 72 months. Now, I'm not sure whether with the regular agreements, if they've gone up to 84 months, not 100% sure of that, because this is something that is brand new, that they finally decided to make it permanent. I want to say less than a week ago, a couple of days ago. So they haven't, and I'm quite sure they're going to tweak things here and there. So things are going to change here and there. That's why it's important that you work with an individual who is familiar and who keeps up to date on what's going on. That way they know the newest and the latest changes that the IRS has made. Now, the thing about the regular agreement is that the IRS conducts a thorough review of your financials. They pretty much look to see what you owe, or rather they just dig deep in. The disadvantage to the regular agreement is that whatever your disposable income is after the IRS does their financial calculations, saying, okay, based upon what the IRS allows, you are now left with $5,000 a month after all of your expenses have been paid. The IRS wants the entire $5,000. They want the entire $5,000. They don't. So it's almost as if they don't even look at it and say, okay, well, you can pay this, or you can pay less, or we'll just divide it by a certain number of months. What they usually tend to do is they want to take whatever your disposable income is. Usually that's how they operate. That being said, there is some flexibility there. There is some flexibility. So usually if you're in a situation where you are going to be required to have a regular agreement, you definitely want to work with a professional, because at that point you're going to need somebody who truly understands what you can and cannot get away with. Because the IRS, if you try to do it on your own, you don't know all the laws, you don't know all the rules, the IRS will take advantage of that. If you're dealing with a professional, they know the laws, they know the rules, so they can sort of push back with the IRS. Now, when I say push back, I'm not saying be mean or be nasty, because you don't want to be mean or nasty to the IRS, because they pretty much are in control. But basically what we do is we just present them with a statute that says, okay, well, this is what is allowed and then this is what's not allowed. Because even with us, sometimes they'll try to, do things that they're not supposed to do, just to see how much they can get away with. If you know the law, then you can push back. If the person you're dealing with is not too familiar with the law or is not able to research, then you are at a disadvantage. So my advice is, if you fall into the category where you need someone to help you with a regular agreement, you definitely want to speak with somebody who has experience in this area. Now, as I mentioned earlier, the advantage of the streamline, where you no longer have to show financials, means that now you can just divide whatever you owe by the number of months given, which is either 72 or 74, and pay that. Versus with a regular, where whatever the disposable income is that's left over is what the IRS wants. Now, let's keep in mind, let me just say one thing, that the IRS, they want you to pay what you owe them within the statute. So let's assume that the statute of limitation is only 3 years, and you're trying, and you owe the IRS, and you qualify for a streamline, which means that ordinarily you would have to pay between 6 years, or rather you would have to make your payment between 72 months or 84 months, depending upon where you fall. However, the statute of limitation that remains on your particular on your particular debt happens to be 3 years. Well, in that case, the IRS, they want all of the money within that 3 years. However, once again, as I mentioned earlier, there's a solution for everyone. Let's assume that is you, but you can't afford to pay them all what you owe within the statute of limitation. Then there's something called the partial agreement, okay? Also known as the PPI. So it's partial pay installment agreement. I believe that's what it means. So this particular agreement, you can qualify if the statute of limitation happens to be running out, or even if the statute of limitation is not running out. Let's assume that you still have about 9 years, but you can still only afford to partial pay. That's fine, as long as the financials says the same thing. Okay, so what's a partial pay? It's the same as the regular agreement, but with one exception. The taxpayer isn't able to pay the balance due in full within the statute of limitation. The IRS will revisit your liability, usually within about 2 years, to see if you can afford to increase your monthly payments. Now, when they're doing a partial, you have to submit financials, because if you can't afford to pay everything, the IRS wants to make absolutely sure and be certain that you truly cannot afford to pay everything. And the only way that they're able to make that determination is if they look at your financials. If your financials say, okay, based upon what this Mrs. Anderson's financials, when it's all said and done, all she's left with at the end of the month is $150. Now, technically speaking, based upon what she owes, she's required to pay $1,000 a month. But because she's only left with $150, we'll take the $150, because they rather take something than take nothing. So we'll go ahead and take the $150, and we'll say, okay, we'll just take that. But we're going to check up on you in about 2 years to make sure that nothing has changed. If nothing has changed, then okay, we'll keep accepting the $150 until the statute of limitation runs out, and then you're good to go after that. And even then, if something should happen where now all of a sudden you can only afford to pay $50, well, that's fine too. You just resubmit financials. The IRS will take a look at it, and they'll say, oh, okay, she can only now afford to pay us $50 from $150, even though she's supposed to pay us $1,000, but that's fine. We'll take the $50. Something is better than nothing. Now, there's also something that's called a 1-year option. Now, the 1-year option gives you an opportunity to adjust your expenses. Now, what this is let's say that you have, I work with clients who, I'm able to get this particular option for them because they may have a lot of debt. Let's assume that their debt every month comes to about $8,000. Well, clearly the IRS is going to say, I don't care that your debt is $8,000. You owe us money. You go figure out a way to bring that debt down. So what do you do? Now, with this particular option, you pay less than the IRS requires for about a 1 year, for a 1 year period. They give you that 1 year period to adjust your expenses. After the 1 year is up, they absolutely require you to start paying the minimum amount. So what they're basically saying is, okay, we want you to take those. Okay, you have $8,000 in expenses. We're only going to give you, based upon your financials, you qualify for $2,500, but you got $8,000. Go figure out a way to get rid of the $8,000 and bring it down to $2,500, or bring it down to what we will allow. And in this case, it's $2,500. Bring it down to $2,500. We give you 1 year to do this. Okay. Once that year is up, we want our 25. We don't care how you do it, get it done. And that's pretty much it. So they give you that option. You get that 1 year option to go back, reassess, readjust, and then come back to the table a year from now with the ability to pay. Okay, so how to default on an installment agreement. Okay, well, I put 3 different ways of how to default on an IA. Okay, one is to incur new tax debt. So let's say every year, even though you have an installment agreement, you just keep doing the same things over and over and over and over and over again, where you have a tax liability at the end of the year. As an independent contractor, what you're doing is you're not paying your estimated taxes. So at the end of the year, you wind up having another tax debt. For a W-2 employee, you may change your W-4 form, and therefore not enough is deducted, which means all of a sudden, once again, you have a debt. Or you may go pulling money out of your retirement account without making the necessary payments to the IRS. Well, what happens? Well, you have a tax debt. So one way to default on an agreement is to keep incurring more tax debt. So you want to not do that. Another way to default is to fail to fail to file your tax return timely. So your tax return is due on the 15th of April of every year. That date doesn't change. It stays the same. But for some strange reason, I get people calling me December 13th saying, oh my goodness, I need to get you my stuff. And I say to them, oh my goodness, why didn't you get it to me earlier? Remember, it was due April 15th of 2 years ago, last year, this year. But, it happens. No big deal. I deal with it. In a situation like that, you can just go, I'll put them on extension. They can go on extension. So even though they may have failed to file the tax return on time, which is April 15th, or it could be the 16th or the 17th, depending upon what day the 15th falls on, if it's on a holiday, weekend, or whatever the case may be. So we put them on extension, which is October 15th if they're for personal, and then September 15th for business returns. So that's fine. If you go on an extension, then you're not considered you weren't considered not filing on time. So you have to file before the due date, which is April 15th, or go on extension and then file by October 15th. Another way to default on an installment agreement is to fail to pay your installment agreement payments. If you decide to stop paying your payments for whatever reason, then all of a sudden you are now defaulting on your installment agreement. So you want to make sure that you keep paying it. And as I mentioned earlier, if for some reason you can't afford to pay it, contact the IRS. Don't contact the IRS. Contact a licensed professional who can help you to renegotiate what you're currently paying. Now, what is an offer and compromise? Okay, so other than it being pennies on the dollar, which is what a lot of these advertisers like to refer to it as, an offer and compromise is a situation in which the IRS accepts less than the total owed by a taxpayer to settle the taxpayer's outstanding tax debt. Now, what many taxpayers don't understand is that the offer and compromise program at its core is a formula, which means that many offers filed by taxpayers and some practitioners are not accepted because they fail to consider the formula and make offers that stand absolutely no chance of success from the moment they are filed with the IRS. Now, I say before, if anybody ever tells you that, oh, we can get you an offer, before they actually sit down with you and have a conversation and go through a preliminary analysis, then I say run the other way, because now they're just trying to trick you out of money. Because these offers and compromise can get expensive. And the reason why they can get expensive is because we can take you from owing $500,000 to possibly paying $1,000. So to me, I think it's worth, whatever a person is charging you for, if they can take that amount of debt off of your plate. But because it is expensive, you want to make sure that before you hand somebody over any money, that they have your best interest at heart, and that they're not trying to scam you and take advantage of you, but that they are giving you, they show you the numbers, give you and like I said, nothing is necessarily guaranteed, because the IRS, you just never know which way they're going to go. It is a formula, and therefore it's based on that. So now, sometimes I have clients that come in that don't tell me the truth, the whole truth, and nothing but the truth. And if you don't tell your practitioner the truth, then that could be a problem, because where they thought that the offer and compromise would be accepted may no longer be accepted because of items that you didn't disclose. So you want to make sure that you are being completely forthright, telling your service provider exactly what they want to know as it relates to all of your assets, just to make sure that when they do the preliminary, they can tell you truthfully whether or not you qualify, rather than you holding back, them assuming you qualify, them taking your money, going through the entire process only for you to be told, oh, by the way, you do not qualify. Now, because the OIC is based on a mathematical calculation, offering a random amount to settle your case is not an option. So if the calculation makes sense, your offer will likely be accepted. Now, when I say random, offer, you can't just say, because people truly think that you can just tell the IRS, okay, IRS, I owe you $40,000, but I'm going to give you $20,000. Do you accept? And the IRS comes back and say, oh no, we don't accept 20,000, but we'll take 25. And then you say, well, no, I only have 2250. No, it's not that kind of negotiation. It doesn't work that way. You have to literally qualify based upon the IRS's financials. And when they look at your financials, they scrutinize. They go to third parties to find out what you own. They will pull your records from wherever they possibly can to see exactly what you own. So if you're trying to hide assets, they will find them. Okay. Now, the IRS accepts or denies an offer based on the reasonable collection potential, meaning that they are going to accept it or they're going to not accept it based upon how much they think they can collect from you. If they believe they can't collect anything from you, then they'll take the offer. Like I said, something is better than nothing. But if after doing all the calculations, they realize, oh no, we can get more out of this person, then they're going to try to collect every single dime that they possibly can. Now, we have three types of offers in compromise. We have doubt as to collectability, we have doubt as to liability, and we have the effective tax administration. Now, the doubt as to collectability says that, okay, more than likely, we're not going to be able to collect all the money. Miss Anderson owes us $500,000. It is clear by her financials that we will never be able to collect that from her. So let's go ahead and negotiate. Okay, fine. Doubt to liability means that you are saying that, I don't owe this money. I have no idea what you're talking about. You say I owe $120,000. Well, either I don't owe you anything, or by my calculation, I only owe you $20,000. That's doubt as to liability. So you're saying, no, I don't owe all this money. And then finally, you have the effective tax administration, which means that the IRS has gone through, they have gone through all of your financials, and it has been determined that you owe them the money And not only do you owe them the money, you can afford to pay them based upon the assets that you own, whether it be cash in your account, whether it be your home that's paid off that has tons of equity, whether it is a ton of boats that you might own, whether it is a retirement account. So whatever the case may be, they see that you can afford to pay them. However, for some reason, although you can afford to, you're not able to and the because can be because you are sick, you have cancer, or you have some type of debilitating illness that is going to require you to use the money that you have to take care of yourself. You may be a retired individual. So let's say you're retired. You have absolutely no more money coming in. Okay, you have no more money coming in. So whatever you have got to live on it. So let's say you're 65 years old. Either you're retired due to disability, and the IRS's calculation says that more than likely you are a female, 65 years old, you live here, which means more than likely you're going to live to about 1,000 years old. Then there is a calculation that you need to come to see whether or not by you paying them what you owe them, it's going to cause you to not have any money to live. And once again, like I said earlier, if you are sick and you have incredible debt, bills you have to pay for your medical care, then you may fall under the category where you don't have to pay them back. Now, this is very, very difficult to get. Okay, it's not easy to get this. More than likely, if you apply for the Effective Tax Administration, more than likely the person who is actually the OIC officer who is handling it is likely going to say, sorry, we reject it. You're more than likely going to have to go to appeals with this one. And if you have all of your paperwork in check, all of your paperwork intact, and you can prove whatever it is that they want you to prove, you should be fine. But it's a hard one to get, but it is available. Then we have bankruptcy and your tax debt. I always say hire an attorney. Okay, first and foremost. If you are considering bankruptcy, hire an attorney. I always say I am not an attorney, and I don't play one on the radio, nor do I play one on webinars. So I can't help you as an attorney. However, I can tell you a few things. So as I said, I can't give you legal advice. And let me clarify a few things about how bankruptcy may affect your tax debt. So I'll just do that really quickly. Okay, so can your tax debt be discharged under bankruptcy? The short answer is yes, it can be. However, the general rule is the taxes has to meet several exceptions in order to be dischargeable in bankruptcy. So we have two types of bankruptcy. We have Chapter 7, which discharges your entire debt. And then we have Chapter 13, that restructures your debt with possibility of a partial discharge. And for some strange reason, I have the same information on this slide. So I'm going to skip where it says types of bankruptcy and just skip to benefits of bankruptcy. So the benefits of a bankruptcy is you get an automatic stay. So Section 362 of the Bankruptcy Code provides that all collection activities by creditors must cease, including the IRS. So which means if you owe the IRS, the minute you go into bankruptcy or somewhere there, they cease to try to collect money from you. Now, taxes may be discharged depending upon your certain circumstances. And like I say again, consult an attorney for advice. I keep saying that because I just want you all to know that I'm not giving legal advice, and that you do need to contact an attorney when it comes to bankruptcy issues. So am I eligible for a discharge? Let's see. Let's talk about the 3-year rule. Your taxes are eligible for discharge under these circumstances. Now, there could be other factors involved that I'm not aware of, because once again, I'm not an attorney. I can't say that enough. So just based upon the tax rules, I can tell you what makes your debt eligible, but an attorney is going to help you finalize this whole entire thing. Okay, so there's a 3-year rule. That means your tax must be more than 3 years old based on due dates of return with regard to extension, which means that you have to have filed your tax return at least 3 years ago. Okay. Then there's the 240-day rule, which means that tax must have been assessed at least 240 days prior to bankruptcy. And this could be any additional tax from an exam or from an amended return. So let's assume that you submitted your tax return, you were assessed, everything is all good, but then something happens where an additional tax was assessed on that same tax return. This means that it has to be at least 240 days old for that portion of the tax debt to be dischargeable in bankruptcy. Now, if I'm talking out the side of my mouth and I don't know what I'm talking about, I would definitely welcome any attorney to correct me. I think I'm right. I'm quite sure I am, but I'm up for correction because, once again, I'm going to say again, I'm not an attorney, so please speak with an attorney. Okay, so then there's a 2-year rule, which means a late filed return must have been filed more than 2 years before the bankruptcy petition, which means that if you filed your return late, let's say it was due on, let's say for 2018, it's due April 15th of 2019, but you filed it late, let's say 2 or 3 years after the fact. Well, the 2-year rule says that a late return must have been filed more than 2 years before the bankruptcy petition date. And then there's the non-fraudulent return rule. Basically, this means if the tax return in question cannot have been deemed fraudulent. So it can't be a fraudulent return. Okay. And then let's see. Then there's a non-tax evasion rule saying that the taxpayer must not have willfully attempted to evade taxes. So if you willfully attempted to evade taxes, then more than likely you don't qualify for a bankruptcy discharge. Then there is an unassessed income tax, meaning that income tax must have been assessed as of the petition date. So if you file for bankruptcy, and if for some reason in the process of filing for bankruptcy or the petition date, some tax was assessed for whatever reason, it means that that particular part that was unassessed by the petition date cannot be discharged under bankruptcy. And then there's a payroll, withholding, and other trust fund taxes. So if you are liable for collecting the government's money, whether it be some kind of payroll tax or whether it be some kind of sales tax, the money basically isn't yours. You take it from somebody and you're required to submit it on their behalf to a taxing authority. That part of what you owe cannot be dismissed under bankruptcy. Now let's talk about unfiled tax returns really quickly. So unfiled tax returns. Now let's say you haven't filed a tax return in 10 years. The IRS only requires that you go back 6 years, which means if you haven't filed a tax return since 2008, so you owe 10 years of tax returns to the IRS, you are not required to file all 10. By law, you are only required to go back 6 years, and that's it. Now, you can choose to go back more than that if you have to for whatever reason. Now, the reason can be that you're applying for a particular job, a particular position, and that position is asking you the question, have you filed all of your previous tax returns? Well, before you check the box yes, you want to think back and say, did I really? So if you took advantage of the 6-year rule and did not file the prior 4 years, then you're not really supposed to check the box yes, because technically speaking, you didn't file all of your returns. So if there is a reason like that, or some other reason that is going to require you to file all prior 10 years, 11 years, 20 years, whatever the case may be, then yes, you go back and file for that reason. But strictly for IRS purposes, you're only required to go back 6 years. Now there is of course the 6-year rule exception, which means that if the income came from illegal sources, then you don't fall under the 6-year rule. If you're hiding or concealing assets, you don't fall under the 6-year rule, or any other reason that benefits you. So if there's a reason why you didn't file it that benefits you in some way that the IRS, looks funny on, or rather looks at looks at you side-eyed, basically. They're going to use side-eyed and saying, really, did you really do that? Well, under those circumstances, then the 6-year rule does not apply to you. So that's the end of the webinar, and this was supposed to be a live webinar, so that's why you see questions, but since it's not live, then there are no questions. But I do implore that if you feel free to email me if you have any questions. And also hopefully you saw, as I was going through the webinar, you saw a link where you could click on to download a PDF that I have for you, and the PDF is called Navigating Your Way Through IRS Collections. It has a lot of good information that I think will benefit you. And I do believe that I have a link as well that you can click on to make an appointment if you'd like to speak with me further. I am giving a 30-minute free discovery where you can speak with me if you have any questions. And then here is my contact information displayed so beautifully on the screen. You can take that information and you can contact me either via email, Facebook, or go onto my website, and even on Instagram. I try to help beauty industry professionals transform their financial life. And not just transforming their financial life from a business perspective, but also transforming their financial life from a personal perspective. Because at the end of the day, what we do for a living is what helps us elevate our personal lives, right? It helps us to save for retirement. It helps us to purchase vehicles. It helps us to purchase homes. It just helps us to go on vacation. Everything that we do in our business lives helps better our personal lives.